Hi everyone, before I start this video, make sure that you're a part of my Discord server by joining the link in the description box below. And in this video, we'll be going over A-Level Accounting 2024, February-March, Paper 1-2. This is Paper 1, which consists of 30 multiple choice questions, and we have a total of 1 hour. So in this video as well, we'll be attempting to solve this paper under 1 hour. Without any further delay, let's get started. For the first question, which statement about sole traders is correct? So for the first option, they always trade by buying and selling goods. This is not true. Sole trader can also manufacture on their own and sell the goods that they have manufactured. So option A is incorrect. For the second option, they do not employ any staff. This is also incorrect. Sole trader does not mean that there has to be a single person handling all of the operations of the business. It just means that only single person will invest the capital required in order to establish the business, but that single person can employ any other staff as well. So second option is also incorrect. For the third one, they keep all their profit themselves. This is true because there's only one single person who is investing their capital into the business, which means that the profit will only go towards that person which has invested into the business. So this is the correct answer. Let's take a look at the fourth option as well. They maintain a retained earnings account. This is incorrect. Retained earnings will only be maintained by companies, and we're talking about sole traders in this case. Now, for the second question, which source of finance would be available to a public limited company but not to a partnership? For the first option, we have bank overdraft. So bank overdraft is something that is available to both public limited company as well as a partnership. So this is incorrect. For the second one, we have debenture. Now, debenture is similar to shares, and we know that only public limited company or any sort of company will be allowed to issue shares, but partnership cannot issue shares. And debenture is the same case. So public limited company will be able to issue debentures, but in case of partnership, they will not be able to do so. So this is the correct answer we're looking for. Let's take a look at the remaining options as well. For the third one, we have leasing. So leasing is just renting property, and that is available to both public limited company as well as a partnership, which means that this will be incorrect. And we have trade credit. So trade credit just means that you will be able to purchase on a credit basis, and that facility is available to both public limited company as well as a partnership. So this is also incorrect. Let's move towards the third question. Which items will be debited to the accounts in the purchases ledger? So remember, for purchases ledger, we include the purchase on the credit side, right? So any of the items which will increase the purchase will go towards the credit side. Any items which will decrease the purchase will go towards the debit side. And discount allowed is something that happens when there is a sales. But in this case, we're talking about purchase. So this is incorrect. For the second one, we have payments to suppliers. Now, if we make payment to supplier, the credit purchases amount that we are yet to pay will be reduced. So we're talking about reduction, which will go towards the debit side. This is correct. For the third one, we have purchases. So purchases will obviously be entered on the credit side. So this is incorrect. For the fourth one, we have purchases returns. Now, purchases returns is something that will reduce the purchases. So that will again go towards our debit side. So the correct answer should include 2 and 4, which is given by option D. Let's move towards the fourth question. Tom bought goods costing 100 on credit from Sam. He returned goods costing 20 as faulty. He deducted a cash discount and paid 76 by check in full settlement. Which amounts were recorded in Tom's books of prime entry? So Tom is the person who bought the goods. Okay. So we know that we purchased goods costing a total of 100. So first entry would be purchases of 100. Then he returned the goods. It means that there is also purchase returns of 20 in this case. And then he deducted a cash discount and paid 76. So if we made returns of 20, it means that the actual purchase was only of 80. So this is the amount we should have paid, but we had a cash discount, after which we only paid the amount of 76. So paid amount was only 76, which means that the cash discount in this case was 4. Okay, and remember, cash discount is something we do not record in our books of accounts. Only trade discounts will be recorded in our books of accounts. So we can ignore this 4. Now let's take a look at the options. So we have purchases journal. So we know that we made purchases of 100. So this is the amount we're looking for, which is given in option C and D. Then we have purchases returns journal as well. We know that for purchases returns, we return goods worth of $20. So that will again be C and D. Then we have the 3-column cash book, and this is the bank column. And remember, we're talking about cash book. It means that we need to include the amount that was actually paid out of our bank account, right? And the amount paid is 76. So that's the amount we'll record, not the purchase amount of 80, because we had a cash discount of 4. Although we do not record the cash discount itself within our cash book, we only record the cash that was actually paid rather than the amount that should have been paid. So in this case, instead of including 80, we should only include 76, which is given by option A and C. So the correct one for all 3 of these headings is given by option C. That's our correct answer. Let's move towards the 5th question. What are the characteristics of non-current assets? For the first one, they are not intended for resale. This is true because we purchase a non-current asset so that our business can use it in order to improve their productivity as well as efficiency. So this is correct. For the second one, they provide future economic benefits. Again, like I said, for the first option, we use the non-current assets so that the company can improve its productivity and efficiency. And that would result in some sort of future economic benefits to the business, which is why the second option is also true. For the third one, they prevent the company from going out of business. So non-current assets does not ensure that the company will remain in business for the entirety of its lifetime. So this third option would be incorrect, because non-current assets definitely do not prevent the company from going out of business, because there are many companies which have used the non-current assets but still have gone out of the business. So the correct answer should include 1 and 2, which is given by option A. Let's move towards the 6th question. At the beginning of the financial year on 1st January, a business acquired new motor vehicle for 34,000. So this is the cost of the new motor vehicle. In error, this was recorded in the account for motor expenses. So remember, purchase of new motor vehicle is actually a capital expense, which will be capitalized. It means that the correct entry would have been just a charge for depreciation as part of our expenditure within the statement of profit or loss. But in error, the entire amount of 34,000 was recorded as motor expenses within the statement of profit or loss. Motor vehicles are depreciated using the reducing balance method at the rate of 30% per annum. It is estimated that the motor vehicle will have a residual value of 4,000 at the end of its life. Now, another important thing to remember for depreciation is that the residual value will only be used for straight line method. Since in this case we are talking about the reducing balance method, we can completely ignore this information. Now, if the error is not corrected, what will be the effect on the profit for the year ended 31st December? Okay, so in this case, we included the incorrect expenses as 34,000. Right? Instead of capitalizing it, we included this as part of our motor expenses. Now, the correct expenses would have been the depreciation charge. And since this is a reducing balance method and we're talking about first year of this new motor vehicle, so there will be no accumulated depreciation. We can just use the cost and multiply it by our rate per annum. So that will be 34,000 times 30%, which results in a value of 10,200. Now the correct expenses should have been 10,200, but the incorrect expenses that we included was 34,000. It means that our expenses was overstated. An overstated amount will just be the difference. So 34,000 minus 10,200. That results in the amount of 23,800. And we need to talk about the effect on the profit. So if the expenses are overstated, it means that the profit will be understated by the same amount. So we're looking for 23,800 understated, which is given by option B. That's the correct answer. Let's move towards the 7th question. A company purchased a machine on 1st April 2021 for 25,000. So this is our cost. It was depreciated at 20% per annum using the straight line method. A full year's depreciation is charged in the year of purchase, but none in the year of sale. On 30 June 2023, the machine was sold for 12,500. This is our sale proceeds. The company's year end is 31st December. What was the profit or loss on the disposal of the machine? So in order to calculate profit or loss on disposal, we just need to compare the net book value at the time of disposal to the sales proceeds. We already have the sales proceeds. Now the next step would be to calculate our net book value. Okay, let's create a timeline first. So this is the year 2021. 2022, 2023. Okay, and we know that the company purchased the machine on 1st April 2021, and according to our policy, a full year's depreciation is charged in the year of purchase. So we need to charge a full year's depreciation for the year 2021. Then we need to charge the full year's depreciation for the year 2022 as well. And on 30 June 2023, the machine was sold. So it was sold here. Again, according to our policy, no depreciation is to be charged in the year of sale. So we don't need to worry about depreciation for the third year. Now our accumulated depreciation is just going to be a depreciation charge for 2 years, right? For the year 2021 and 2022. And in this case, we have a straight line method. So we can just multiply our cost by our rate of depreciation and multiply it by 2 so that we get the depreciation charge for 2 years. That will be 25,000 times 20% times 2. This results in the amount of 10,000. Now we can easily calculate the net book value. That will be cost minus accumulated depreciation. The cost was 25,000 in this case. We calculated the accumulated depreciation to be 10,000. So the net book value will be 15,000. Now we know that the sales proceeds is of 12,500, whereas the net book value is 15,000. So clearly net book value is higher, which results in loss on disposal. And loss is always going to be the net book value minus sales proceeds. That will be 15,000 minus 12,500, which results in 2,500. So the correct answer will be a loss of 2,500, which is given by option C. That's the correct answer. Let's move towards the 8th question. Which error will cause a trial balance not to balance? For the first option, an invoice entered as a credit note on original input. So this is the error of original entry, which will not be reflected in our trial balance. So option A will be incorrect. For the second one, a journal entry that does not balance. So if the journal entry itself does not balance, it means that this will also cause the trial balance not to balance, which is what we're looking for in this case. This is why option B is the correct answer. Let's take a look at the remaining options as well. A transaction entered as the wrong amount on original input. Again, this is an error of original entry, which will not be reflected by the trial balance. And we have a transaction not entered in the books of account. So if we have omitted the entry itself, that will be an error of omission, which will again not be disclosed by a trial balance. So that's incorrect. Let's move towards the 9th question. A business prepared a trial balance that included a suspense account. Draft financial statements were prepared which showed a profit for the year of 85,000. The following errors were then discovered. After correcting these errors, the balance on the suspense account was eliminated. We need to calculate the revised profit for the year. Now, in order to calculate the revised profit, we can start with our draft profit for the year of 85,000 and then take a look at our errors. For the first one, discounts allowed of 1,000 had been debited to the discounts received account. So at first glance, this might seem as the 1,000 for discounts allowed have been included as 1,000 for discounts received. But the key word here is debited. Remember that discounts allowed is an expense, right? So for expense, we record the actual expense on the debit side. And this has been debited, but in our discounts received account. And discounts received is an income. So discount received should have been included on the credit side, but we included it on the debit side for the discounts received account. Now what this means is that the actual discounts received account or the actual discount received amount has been understated by 1,000. Because within the account itself, we have the discounts received amount here on the credit side, but we included 1,000 on the debit side. So now the closing balance for discount received will be 1,000 less than what it was supposed to be, which is why it will be understated by 1,000. And this 1,000 should have actually been included as part of the discounts allowed, but this is omitted, which means that our discount allowed is also understated by the same amount. Now, if we rectify this error within the revised profit, what it means is that we first need to add the 1,000 as part of our discounts received, because that is an income. Income will always be added while calculating profit. So we add the 1,000. Then we also need to include 1,000 as part of the discounts allowed, because that was also understated. And discounts allowed is an expense, which will always be subtracted while calculating profit. So we will subtract the 1,000. So basically there is no adjustment because plus 1000 minus 1000 is just going to be 0. Now for the second error, motoring expenses of 4000 had been debited to the purchases account. Now in this case, motoring expenses is an expense, right? It should have been debited. And we were told that it was actually debited to the purchases account, which is also an expense. So in this case, the entry of the amount 4000 has been done correctly because we have treated it as part of the expense, but just under a different heading. So we don't need to adjust this. If we were to adjust this, what it would mean is that again, for purchases, we would have to reverse it because purchases has been overstated by 4000. And remember that purchase is an expense, so if it's overstated, we need to add it back in order to calculate the profit. So we would add the 4000. And again, motoring expenses is understated by the same amount. So the adjustment for this would again be minus 4000. So again, the total adjustment would be plus 4000 minus 4000, which is 0. Then for the third error, a payment for purchases of 5000 had been correctly entered in the cash book, but credited to the drawings account. So instead of including the 5000 within the purchases account, we included within drawings account. And drawings is not included while calculating the profit. So we can skip this error. The error that we need to focus on is that the purchases amount has been understated by 5000 because we did not include this within our purchases account. Now remember that purchase is an expense which will be subtracted while calculating profit. The correction of this error would be subtracting 5000 from our draft profit. That is all. Now the revised profit will be 85,000. This is 0. This is 0 minus 5,000, which is also 80,000. And that is given in option C. Let's move towards the 10th question. Amit compared his bank statement with his cash book. How did Amit deal with the items revealed by this comparison? Now we need to figure out which items would be adjusted while updating the cash book. So while updating the cash book, we include the expenses that have already been included within our bank statement, right? And that would basically include the bank charges and bank interest. We're looking for these two headings. So we have bank charges for option A, that is correct. We have bank charges and bank errors. Bank errors is incorrect because bank errors would be adjusted within the bank reconciliation statement. Then we have timing differences. So timing differences basically refers to our unpresented checks and uncredited deposits, which will again be included within the bank reconciliation statement. So for this one, we're looking for unpresented checks and uncredited deposits, which is basically the timing differences. And like I said before, the bank errors will also be adjusted within the bank reconciliation statement. So we're looking for these two for our bank reconciliation statement. And again, for the fourth option, we have timing differences, which will go towards bank reconciliation statement, not in the cash book. So the correct option is given by option A. Let's take a look at the other column as well for our bank reconciliation statement. We have timing differences, which is correct, as well as bank errors. So that is also correct, which is why option A will be the correct answer. And for the remaining options, we have timing differences. Although this is correct, we do not have a correct option for cash book. So option B is incorrect. Then we have bank charges, which will actually go towards updating the cash book. So that's also incorrect. Then we have bank charges as well as bank errors. So bank charges is incorrect, whereas bank errors is correct. This is why A will still be the correct answer. Let's move towards the 11th question. The bank statement of a business shows a credit balance of 1,570 at 31st December. The following differences were discovered on comparing the cash book with the bank statement. We have unpresented checks and uncredited bankings. A direct debit of 230 was shown as 320 in the cash book. What is the updated cash book balance at 31st December? So if we want the updated cash book, we can just prepare our bank reconciliation statement because we already know that the bank statement has a credit balance of 1,570, which is a positive balance. And if we include the unpresented checks and uncredited bankings, we will get the balance as per the updated cash book. So we can start with a credit balance of 1,570. Then we have unpresented checks. So unpresented checks are the expenses that are yet to be included within our bank statement. And expenses will definitely reduce our bank balance, which is why we need to subtract the 1,250. Then, uncredited bankings are the deposits that are yet to be recorded within the bank statement, which is why we need to add the 1800. And this would result in the figure of 2120, and this will be the balance as per our updated cash book. So the correct answer would be 2120 given in option D. And in this case, we do not use this information because these are the errors that will be included within our cash book. And we require the figure after the adjustment. So this is the after adjustment figure. If we were told to calculate the cash book balance before inclusion of these errors, we would also have to work with the direct debit of 230 shown as 320 in the cash book. But that's not required in this case. Let's move towards the 12th question. What are the benefits of preparing a sales ledger control account? The first one is detecting errors of original entry. Remember that errors of original entry will not be disclosed by any of the accounts, be it suspense account, sales ledger control account, or purchase ledger control account. So this is incorrect. The second one is helping reduce the possibility of fraud. This is correct because sales ledger control account and sales ledger are prepared by two different staff. And we know that the figure from both the sales ledger control account as well as sales ledger should be the same, right? That way it reduces the possibility of fraud. Then for the third one, providing totals of trade receivables for inclusion in financial statements. That is true. The main purpose of sales ledger control account is to calculate the correct balance for trade receivables so that we can include that value within our financial statements. So the correct answer should include 2 and 3, which is given by option D. Let's move towards the 13th question. For question number 13, a company prepared its purchase ledger control account, which showed a balance of 15,960. The following items were then discovered. Now, what was the correct total of the trade payables? So the main purpose of purchases ledger control account is to figure out the correct balance of the trade payables. And in this case, we have the draft balance of 15,960. Now, we are going to prepare a purchases ledger control account and correct these errors so that we get the correct total of the trade payables. Okay. And remember, we're talking about trade payables, which is a liability. And for any liability, the opening balance will always be recorded on the credit side, which is why we will start with 15,960 on the credit side. Now for the first error, discounts received of 450 had been entered into the purchases ledger control account as 540. So clearly this is a case of overstatement. Now the overstated amount will be 540 minus 450, which results in 90. So it should have been 450, but we entered it as 540. And we're talking about discounts received. So discounts received is something that will reduce our trade payables. So originally this balance should have been entered on the debit side, but we increased it by 90. Now in order to correct this overstated amount, we need to enter it on the opposite side. Because previously it was 540. If we enter 90 here, the balance or the net total will be 450 on the debit side. That is what we want. That's why we should be entering 90 on the credit side in this case. Then a payment of 720 to a supplier had not been entered in his account. At first glance, this might seem like a payment to supplier having been omitted, but in this case, we're referring to his account. It means that it had not been entered in the supplier's account. So we're not really concerned with what goes on for the supplier's account. That is why there is no need to correct this error. We can just skip this. Then the purchases ledger debit balances carried down totaling 110 had been omitted from the control account. This is a debit balance and we're talking about purchases ledger. So the purchases ledger debit balance of 110 just refers to the purchase amount, right? And this had been omitted from the control account. Now we just need to enter purchases within our purchases ledger control account. We know that all of the credit purchases will be always recorded on the credit side. So we're just going to enter 110 on the credit side. Then a contra of 170 had been entered in the purchases ledger, but not in purchases ledger control account. So now we just need to enter a contra of 170 within this control account. And contra for purchases ledger control account will always go on the debit side. So we have 170 here. Now we can easily calculate the correct balance. For that, we need the total from our credit side. So 15,960 plus 90 plus 110 results in 16,160. Now the closing balance, or the correct balance in this case, will be 16,160 minus 170, which results in 15,990. This is the correct answer we're looking for, which is given in option C. Let's move towards the 14th question. Deepak provided the following information. We have information for end of year 1 and end of year 2. We have the allowance for irrecoverable debts as well as the rate of allowance. By how much did the total of trade receivables change from the end of year 1 to the end of year 2? Okay, so we just need to calculate the balance for trade receivables at end of year 1 as well as end of year 2. And we'll use the formula in order to calculate the allowance for irrecoverable debts, right? So allowance for irrecoverable debts is just going to be trade receivables times the rate of allowance, right? So for year 1, the allowance is given to be 600. We're trying to calculate the trade receivables, and the rate of allowance is 3%. So the trade receivables itself will be 600 by 3%, which results in 20,000. We repeat the same process for year 2. And in this case, we have allowance of 800. We're trying to calculate the trade receivables, and the rate of allowance is 5%. So the trade receivables at the end of year 2 will be 800 divided by 5%, which results in 16,000. And in this case, we need to figure out the change in trade receivables from end of year 1 to end of year 2. We know that for year 1, we had 20,000 for trade receivables, and year 2, we have 16,000. So clearly there has been a decrease. And the decrease amount is just going to be the difference between these two values. So 20,000 minus 16,000. That results in 4,000. So the correct answer we're looking for will be 4,000 decrease, which is given in option A. Let's move towards the 15th question. A sole trader began a business on 1st January with 50,000 capital. During the year, she introduced to the business her own private vehicle, which had cost 22,000, but which was valued at 16,000 when she added it to the business. So always remember that whenever a sole trader or any partner in a partnership contributes their private non-current assets, we include it at its value or the revalued amount rather than the cost. Alright, so in this case as well, 16,000 will be added to the capital. Then drawings for the year were 20,000. At the end of the financial year on 31st December, the closing balance on the capital account was 105,000. We need to calculate the profit for the year. This is quite easy. For capital, we always start with opening balance. We then add any other additional contribution. So any other addition to the capital will be added. We also add profit for the year. We then subtract the drawings, which will result in the closing balance. Now in this case, we have the opening balance of 50,000. We've already decided that for any new contribution for non-current assets, we will include it at the revalued amount rather than the cost. So we can ignore this 22,000. We will only include the 16,000 as part of our additional capital. We're trying to calculate profit for the year, and drawings were given to be 20,000. And the closing balance is also given to be 105,000. Now profit for the year is just going to be 105,000 minus 50,000 minus 16,000 plus 20,000, which results in 59,000. So this is the answer we're looking for, which is given in option C. Let's move towards the 16th question. Which provision of the Partnership Act 1890 applies when there is no partnership agreement? For the first option, partners receive 5% interest per annum on their capital contributions. This is incorrect because if there is no partnership agreement, the partners will not receive any interest on capital. So option A is incorrect. For the second option, partners are charged 5% interest per annum on their drawings. This is also incorrect because if there is no partnership agreement, the partners will not have to pay any interest on their drawings. Then for the third one, partners receive interest of 5% per annum on loans to the partnership. This is the correct one. If there is no partnership agreement, then the partners are entitled to 5% interest on their loan contributions towards the partnership. Let's take a look at the fourth option as well. Partners are entitled to equal amounts of salary. Again, this is incorrect because if there is no partnership agreement, no partners will get any sort of salary. Let's move towards the 17th question. A partnership provided the following information for the year. Okay, we have gross profit, operating cost, bank interest, interest on partner's loan, interest on capital, and interest on drawings. What were the profit for the year and the residual profit shared by the partners? So let us first calculate profit for the year. For this one, we need to start with the gross profit of 76,000. If we remember the statement of profit and loss, after gross profit, we subtract all of our operating costs, which is 30,000. Then we subtract all of our finance costs, right? That will include the bank interest as well as the interest on partner's loan, because both of these are interest on loan. So we have minus 1300 minus 600. Now this will give the profit for the year to have the value of 44,100. Now we also need the residual profit. In order to calculate the residual profit, we need to follow the format of our appropriation account. So within appropriation account, we always start with profit for the year. So we have 44,100. Then we have the interest on capital. So interest on capital is something that the partnership will pay to the partners. So this will definitely reduce the profit, which is why we always subtract interest on capital within our appropriation account. So minus 5,600. Then we have interest on drawings. Now interest on drawings is something that the partnership will receive from the partners. So it will definitely increase the residual profit, which is why we always add interest on drawings within our appropriation account. So we have plus 2,000. And this results in the residual profit to have the value of 40,500. So the correct answer we're looking for should include 44,100 as profit for the year and 40,500 as residual profit. And that is given in option A. Let's move towards the 18th question. Why is a statement of changes in equity prepared? The first one is to calculate profit when incomplete records have been kept. This is incorrect because if we were to calculate profit in case of incomplete records, we would have to prepare the statement of profit or loss, not the statement of changes in equity. For the second one, to match the dividends paid to profit for the year. Remember, we do not really match the dividends to profit for the year. We just subtract the dividends paid from our retained earnings, which is basically accumulated profit for the year. So this is also incorrect. For the third one, to show the change in capital employed. Now, the term capital employed will include all of our equity and reserves, along with the non-current liabilities. But the statement of changes in equity will only include the changes in equity and reserves, not the non-current liabilities, which is why option C will also be incorrect. And for the fourth one, to show the movements in the shareholder's stake in the business. So the shareholder's stake just refers to equity. And currently we're talking about statement of changes in equity, which shows the movements in the equity in the business. So option D will be our correct answer. Let's move towards the 19th question. The trial balance of a company at 31st December at the end of year 1 included the following amounts. We have ordinary share capital and the nominal rate is 0.5 per share. We have share premium and the retained earnings. Then we need to calculate the balance on the share premium account after these transactions. Okay. On 1st January in year 2, the company made a rights issue of 400 shares at a premium of 0.70 per share. This was fully taken up. So the premium is 0.70. So we can easily calculate the value that will go towards share premium due to this rights issue. So that would be the number of shares, which in this case is 400,000, times the rate of premium, which is 0.70. So that will be 280,000. Now for the balance on the share premium account, let's start with the opening balance. And you can just remember the format for statement of changes in equity, but for the share premium column. So the opening balance is 200,000. Then we need to include another 280,000, and this is due to a rights issue. So for rights issue, it will increase our share premium account by 280,000. Then on 1st July in year 2, the company issued bonus shares at the rate of 1 new share for every 4 held. Okay, so for every 4 ordinary shares in the company is now providing 1 new bonus share. And we have 2 different ordinary shares. We have the opening balance as well as the rights issue. For rights issue, we know the number of shares to be 400,000. Let's calculate the number of shares for this 800,000. So in order to calculate the number of shares, we just divide the total value by the nominal rate. So that will be 800,000 divided by 0.5, which results in 1,600,000. So the total number of ordinary shares right before the bonus issue will be the opening number of ordinary shares, 1,600,000, plus the new right shares of 400,000. So we have a total of 2 million ordinary shares. Now we use the unitary method. So for 1 ordinary share, we need to provide 1 by 4 bonus shares. We have a total of 2 million ordinary shares. So we need to provide a total of 2 million divided by 4 bonus shares, which is going to be 500,000 bonus shares. Now remember that bonus shares can only be issued at the nominal rate. So the value that will go towards the ordinary shares column within our statement of changes in equity is going to be the number of bonus shares, so 500,000, times the nominal rate of 0.5. This results in the value of 250,000. Then we were also told that the policy is to maintain reserves in their most flexible form. Now, if we are to maintain reserves in their most flexible form, it means that for our bonus share issue, we first need to fund it by the share premium. If the share premium is not enough, we can move towards retained earnings. And in this case, we need to fund a total of 250,000. And we have more than enough amount within our share premium account. So we'll fund this entire bonus issue from the share premium account. Now we need to subtract 250,000 from the share premium account. That is all of our transactions, so we can calculate the closing balance. That will be 200,000 plus 280,000 minus 250,000, which results in 230,000. This is the balance on the share premium account after the given transactions. And this value is given in option A. That will be our correct answer. Let's move towards the 20th question. Jim is a manager in a limited company. He also owns a few of its shares. Why has he been looking at its most recent financial statements? For the first one, to discover the profit made by his department, as he might receive a bonus. Before bonus, any employee would want job security, and since he also owns a few of its shares, he will also be interested in the dividend rates, right? But the first priority will be for his job security, and that is not the option given in A, which is why this will be incorrect. For B, to find out if the company made a profit, making his job more secure. Now, this is the case we're looking for. This will be the correct answer because Jim is a manager and he wants to stay as a manager within the company, right? In order to make his position secure, the company will have to run in the future as well. And for the company to run, the company should be able to make profit in the future. That is why he is interested to figure out if the company made a profit by looking at the most recent financial statements. Let's take a look at the remaining options as well. For the third one, to know if dividends will increase over the next 5 years, improving his income. So this is something he will definitely be interested in. But again, like I said, the first priority is to make his job secure. Then he will also prioritize having more dividend because that would increase his overall income. But in this case, the first priority is job security. That is why option C will be incorrect. Then, for the fourth one, to see if the company has a good reputation, increasing the value of his shares. Again, this is secondary criteria because if the value of shares increases, it means that he can sell the shares that he owns within the company in order to make some additional income. But again, job security is the top priority in this case. So option D is also incorrect. Let's move towards 21st question. Edge Limited's cost of sales for the recent 2 years, year 2 and year 1, is as follows. We have the average inventory, credit purchases, as well as cost of sales. Which statement regarding the efficiency of inventory turnover is correct? So we're talking about inventory turnover in this case. I think it's better if you calculate it for both the years. So let us calculate the inventory turnover in days for both the years. And remember, inventory turnover in days is just going to be average inventory divided by cost of sales times 365. Now for year 1, we have the average inventory of 65,000. Our cost of sales is of 750,000 times 365. Now this will result in 31.63 days, but since we're talking about days, we always need to round it up. That will be 32 days. Now for year 2, our average inventory is 100,000. Then the cost of sales is 850,000. And this results in 42.94 days. Again, we need to round it up, so that will be 43 days. Now remember, inventory turnover in days, we always want it lower because inventory turnover in days just means how many days is required by the company so that they can turn the inventory into sales. And for year 1, we could sell the inventory within 32 days, whereas for year 2, we need 43 days. So that's a worst case scenario. It means that year 2 is worse because the inventory turnover is higher as compared to year 1. And that is the answer we're looking for, which is, okay, year 2 is worse because the inventory turnover in days is higher. That will be option D. Let's take a look at the 22nd question. Which expense for a business may be classified as a stepped cost? So stepped cost is something that will remain fixed for a certain level of activity. So this will be our level of activity. And this will be our stepped cost. So it will remain constant up to this level, and for another level it will increase. And it goes on like that. So the graph resembles steps. Now let's take a look at our options. The first one is direct labor, which we already know that this is a variable cost, so option A is incorrect. For direct materials, again, same case, this is a variable cost, so it cannot be classified as a stepped cost. Then we have factory rent. Now factory rent is something that can be classified as a stepped cost. Let me tell you why. Suppose one factory can produce 1,000 units. So the rent of that factory will remain constant, right? But let's say now we need to produce 2,000 units. Now in order to produce the additional 1,000 units, we need to rent another factory as well, which is why we now need factory rent for 2 different areas. So the cost will definitely increase up. So previously, let's say it was $100. Now for 2,000 units, it will go up to $200. Because $100 we're paying for one factory, another 100 we're paying for another factory, which is why option C is the correct one in this case. Let's take a look at the last option as well. We have telephone. Again, this is also variable cost because the total telephone cost depends on how many calls we have made from the said telephone, which is why this will be incorrect. Let's move towards the 23rd question. Which statements describe just-in-time management of inventory? For the first one, it increases administration costs as more suppliers are required. For just-in-time management of inventory, we will only bring in the inventory at the time of need, so we don't store it beforehand. But it has no relation to how many suppliers are required, which is why this statement does not correctly describe the just-in-time management of inventory. For the second one, it is a management strategy that minimizes inventory to increase efficiency. That is correct. Like I said before, we do not store inventory beforehand. We only purchase it at the time of need. So this definitely describes JIT management of inventory. For the third one, producers hold only sufficient inventory to meet maximum market demand. That is true. We do not hold any excess inventory. We only hold the sufficient inventory that is required to go through the current level of production. Then for the fourth one, the system benefits cash flow and reduces the amount of capital required to run the business. So JIT management of inventory definitely benefits cash flow because we do not buy the inventory beforehand. We only buy it at the time of need. It means that the cash payment towards suppliers is delayed. So that definitely benefits cash flow, which is why the fourth statement is also correct. So the correct answer we need will be 2, 3, and 4, which is given by option C. Let's move towards the 24th question. The direct materials cost of a batch of soft drinks is 10,000 for 50,000 cans. This is a variable cost because we're talking about direct materials. Then 60 direct labor hours are required at a cost of 40 per labor hour. Overheads are absorbed at 250% of the cost of direct labor. What is the cost per soft drink can to the nearest dollar? Okay, let us first figure out the total cost for the batch. And the batch consists of 50,000 cans. So we have 3 different costs. The first one is direct material. We then have direct labor and we have the overheads. So the direct material for a batch of 50,000 cans is given to be 10,000. Then we are told that 60 direct labor hours will be required at the cost of 40 per labor hour. So the total direct labor cost will be 60 times 40, right? And then for overhead, it is to be absorbed at 250% of the cost of direct labor. So this is the cost of direct labor. So 60 times 40, and overhead is to be 250% of the cost. So we just multiply this by 250%. So this results in the total cost of 18,400. And this is the cost of a batch which consists of 50,000 cans. But we only require the cost per soft drink can. So we require the cost for one can. Let's utilize the unitary method. For 50,000 cans, the cost is 18,400. Now for one can, the cost will be 18,400 divided by 50,000. This results in the value of 0.368. So rounding it off to the nearest dollar, that will be 0.37, which is given by option B. Let's move towards the 25th question. What is an advantage of absorption costing? The first one is it helps to determine a product's selling price. This is true because for absorption costing, we put both the variable cost as well as the fixed overheads per unit while valuing the cost per unit, right? So it will be easier to determine the product's selling price. This is the correct answer we're looking for. Let's take a look at the remaining options as well. It is used to improve operational efficiency. So costing method does not have anything to do with operational efficiency because the only difference is that absorption costing will include both the variable cost as well as fixed overheads, whereas marginal costing will only include the variable cost, right? So it has nothing to do with operational efficiency. This is incorrect. For the third one, it makes it easy to analyze costs at different production levels. Like I said before, if we analyze costs at different production levels, then we would only be talking about variable cost. So that would be an advantage of marginal costing. But absorption costing also includes the fixed cost. That is why this will be incorrect. And for the fourth one, it takes into account only variable cost. Again, this describes marginal costing, not absorption costing. Let's move towards the 26th question. The following information is forecast for the next month. We have the opening inventory, closing inventory, marginal cost profit, and absorption cost profit. Now, what is the overhead absorption rate per unit? Okay. For this, you first need to realize the difference between marginal cost profit and absorption cost profit. There will be a difference in these two costing profits because marginal cost will value the inventory only at the variable cost, whereas absorption cost will value inventory at variable cost as well as fixed overheads. So now if we figure out the difference between these two profits, what we get is the difference in our inventory value due to fixed overhead. So we basically get the fixed overhead for inventory. Now that will be 100,400, the profit for absorption costing, minus 90,600, which is the profit for marginal costing. So this results in the value of 9,800. And also realize that we're talking about the fixed overhead by figuring out the difference in profits. So this will not be the fixed overhead for entire inventory. This will be the fixed overhead for difference in our opening inventory and closing inventory. This is because while calculating profit, we always subtract the opening inventory and add the closing inventory. So this value of 9,800 is the corresponding fixed overhead for these units. And again, remember we subtract opening inventory because what we do is we subtract the cost of sales, within which we include opening inventory and minus closing inventory. So negative plus positive will be negative. We subtract the opening inventory, and negative will be positive. So we add the closing inventory. Now let's figure out these units. So opening inventory is 20,300. And the closing inventory is 22,500. This results in 2,200 units. Now we require the overhead absorption rate per unit. This will just be the fixed overheads divided by the number of units. And in this case, the fixed overhead is of 9,800. And the number of units we have is 2,200. So this gives the value of 4.45. This is the answer we're looking for, which is given in option B. Let's move towards the 27th question. So in this case, X Limited has budgeted monthly overheads of 125,000. Its overhead absorption rate is 5 per machine hour. In July, there was an under-absorption of overheads of 1,000. Now remember that under-absorption occurs when our budgeted overhead is less than the actual overhead, right? And which changes from budgeted data cause this to happen? So we need to figure out which of these scenarios will result in the under-absorption of 1,000. So we know that this 1,000 of under-absorption is the difference between the actual overhead and budgeted overhead. Alright, now the first thing we can do is calculate our budgeted overheads. And remember, budgeted overheads should be for the actual machine hours, right? And we have been given the changes in machine hours here. We first need to figure out the budgeted machine hours. In order to do so, we will utilize our budgeted monthly overheads along with the overhead absorption rate, right? Because we got the overhead absorption rate of 5 by dividing the budgeted monthly overheads by the budgeted machine hours. So the budgeted machine hours is just going to be 125,000 divided by 5, which is 25,000 hours. Alright, so our budgeted overhead is just going to be our overhead absorption rate multiplied by actual machine hours. Now, we have the overhead absorption rate of 5. For the first option, we want our machine hours to be 100 hours less than the budgeted machine hours. So times 25,000 minus 100. This results in 124,500. For the second option, we want 100 hours more. So that will be 5 times 25,000 plus 100, which results in 125,500. Then for the third one, we have 50 hours more. So 5 times 25,000 plus 50, which results in 125,250. And for the fourth one, we have 50 hours less. So 5 times 25,000 minus 50, which results in 124,750. Okay, now let's calculate the actual overheads. And we have been given the changes in overheads as well. So the actual overheads should be 500 higher than the budgeted overhead of 125,000. So 125,000 plus 500. So that will be 125,500. For the second option, it should be 500 lower. So 125,000 minus 500, which results in 124,500. For the third option, we have 750 higher. So 125,000 plus 750, which results in 125,750. And for the fourth one, we require 750 lower. So 125,000 minus 750, which results in 124,250. Okay, now we can calculate actual overhead minus budgeted overheads. So for option A, that will be 125,500 minus 124,500, which results in 1,000. And that is what we require. So clearly option A is the correct one. Let's repeat the same process for the remaining options as well. For option B, we have 124,500 minus 125,500. That will result in negative 1,000. So this is incorrect. Then for the third one, 125,750 minus 125,250. It results in 500, which is also incorrect. And for the fourth one, 124,250 minus 124,750, which is negative 500. That is also incorrect. Let's move towards the 28th question. Which changes result in a decrease in the margin of safety? So margin of safety is just going to be the total units minus break-even point, right? So we have total units, and break-even point is going to be the total fixed costs divided by the contribution per unit. And we're talking about a decrease in margin of safety. So for the decrease, we either require the total units to be lower or the break-even point to be higher. And in this case, we have the options for unit variable cost and total fixed cost. So we're focusing on break-even point. We want which of these scenarios will increase the break-even point. Let's focus on total fixed cost. Since that is part of the numerator, if we want the total thing to increase, we also want the numerator to increase. So we are looking for increase in total fixed costs. That is given by B and D. Now let's focus on unit variable cost. So unit variable cost is a part of contribution per unit. And remember, when we require the total thing to increase, we want the denominator to decrease, right? And we know that the contribution per unit is unit selling price minus the variable cost per unit. Now, if we want the contribution per unit to decrease, we either want the selling price to decrease or the variable cost per unit to increase. So for variable cost, we're looking for increase again. That is given by C and D. So the correct ones for both unit variable cost and total fixed cost is given by option D. Let's move towards the 29th question. A company has the following budgeted information per unit. We have the selling price per unit as well as the variable cost per unit. We also have the fixed costs. What is the increase in break-even sales if fixed costs increase by 33.3%? We require the current break-even point first. And this is the break-even sales. So we're talking about break-even point in sales, not in units. And the formula for that one is just going to be the total fixed cost divided by the contribution per unit multiplied by the selling price per unit. So we have the fixed cost to be 72,000 for current levels. For the contribution per unit, that will be selling price minus variable cost. So 25 minus 10, which is 15. And the selling price is 25. So the current break-even point in sales is 120,000. Now let's increase the fixed cost by 33.3%. So the new fixed cost will be the current fixed cost times 1 plus 33 1 by 3%. This results in 96,000. Now let's calculate new break-even point. Again, the formula is same. We start with fixed cost, which is now 96,000. The contribution does not change because we have no changes for selling price and variable cost. So it will still be 15 and our selling price is also 25. So the new break-even point in sales will be 160,000. Now we need to figure out the increase. So for increase, that is just going to be new value minus current value or the previous value. So this results in the value of 40,000. This is the answer we're looking for, which is given in option B. Let's move towards the 30th question. Which statements about cost volume profit analysis are correct? For the first one, fixed costs remain constant for a range of activity. That is true. For the second one, profits are calculated on an absorption costing basis. This is incorrect because for cost volume profit analysis, we divide cost as fixed and variable, which is not something that we do within absorption costing. So this is incorrect. Then sales revenue increases in direct proportion to output. That is true. This is correct because in order to calculate the sales revenue, what we do is we multiply the selling price per unit to the number of output. So obviously the total sales revenue will definitely increase in direct proportion to output. For the fourth one, there is only one product and there is a constant sale mix. So only one product is true and a constant sale mix is also true because sale mix just means the variety of the product offered, right? So if we only have one product, we want it to remain one product for a longer period of time, which is why there will be a constant sale mix of only one product. So fourth is also correct. The correct answer we're looking for should include 1, 3 and 4, which is given by option C. That is all for this paper. If you found this video useful, make sure that you like the video and leave a comment below. And make sure that you're subscribed to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.